Markets around the world have fallen for the second day straight, but should we as traders and investors be worried? Today we take a look at the dark pool liquidity that's been trading over the last 24 hours, and of course we talk about the latest news and charts. We'll also be discussing whether a great recession could be on the cards. People are starting to get concerned about property once again, and as we know, that's important. But yields were the cause for concern over the last 24 hours. US 10-year, possibly the most important yield curve, is breaking out to a new daily close. And on top of that, semiconductors, the best market in the US, continues to drop. With the S&P 500 finding a critical level we've been discussing all of this week, what happens now that we've reached maximum pain for options? Well, welcome back everybody to the Daily Show where we discuss stocks, commodities, and cryptos. Of course, we'll be talking about the macro leading indicators and the hottest charts. If you like markets, then subscribe and smash that like button. There's a lot to learn in today's video. Let's begin by what sectors were good and bad. It was semiconductors leading the charge on the sell, along with technology, and in particular, Tesla. We still think this stock could be going even lower than it is right now, and we'll talk about that later on today's video. But let's quickly unpack the FOMC meeting minutes. Was there anything to learn here? Not really. I mean, they're flip-flopping like everybody else at the moment. The staff now from the Federal Reserve no longer judge that the economy would enter a mild recession towards the end of the year. Well, yeah, I mean, not the end of the year, but what about 2024 and 25? Well, they still think that real GDP growth will be below expectations. But in general, I guess here, what really is happening is participants continue to cite upside risks to inflation. I think what's happening is higher for longer in terms of yields, and that's causing a huge concern on the markets. We're seeing yield curves effectively look something like this: less rate cuts than expected and slower and less overall. So this means that by 2025, we may have only seen around 1 to 1.5% taken off the top here. Imagine the damage that could do if things start to crumble around. I doubt it will look like this in a year's time. Let's also talk about one of the best indicators that we've used so far that's helped us to kind of really say that this is going to be a bigger correction than we thought in terms of just like a 2 or 3% dip. Well, it comes down to breaking back below the 70, and we continue to see here S&P 500 bullish percent index drop off. Remember, this is something we are looking at, and we're looking for a turn in that later on. A lot of cited concerns about China and Japan as well. Fair enough, we should be looking at those markets right now. We will update you if we see any potential stimulus or something to change the game. But do remember that there are cyclical issues with China's property prices and specifically property transaction volumes that tend to spike over that September into October meeting. So just remember that and keep it in mind when you're talking about markets as well. There will be some anticipation of stimulus. Now, we don't have a new updated chart for this, but I just want to quickly bring it up again. Remember, retail traders have been buying this dip last week, and hedge funds and institutional traders have not been buying it. Often we're seen as the dumb money, and they're seen as the smart money. So, of course, they've been doing the exact opposite of what we've been doing. And for the last basically 4 weeks, in the last couple of weeks, they've been stacking into consumer staples, healthcare, energy stocks, and industrials. Although that might be changing as we look at some of the dark pool liquidity traded very recently. Let's talk about whether we should be concerned as investors and traders long term. Well, the stats are still in your favor. Remember, we've expected August, September, and October to be kind of problematic months up until maybe the middle of October or even the back end of September. But November and December usually reverse that action. And considering what we've had so far this year, when we've had a plus 10% January to July kind of run, we tend to have a 100% strike record to be bullish by the end of the year. Of course, it's just a stat, but it is interesting. Also, remember, this week is maximum pain for trillions of dollars of options expiration, but it isn't the quad witching. Do keep an eye on what happens in post weeks in September. We'll update you here on the channel, but overall, just remember, it's a 7 to 23. But certain things will happen next week that we can also look at from a statistical standpoint now that we're about to see options expiration in only 2 days of trade. What about the sentiment reports? We don't have an update, but look back in 24 hours, we will. And I expect the bulls to really have fallen off here, probably be back in the 30%. But as we like to say, I'm going to guess 38% for the bull run. What do you guys think will happen in terms of how many people will be bullish in the sentiment report as we get it through the next 24 hours. Also, will we see bears return back above 30%? Because if that happens, then we could be looking at a temporary low here in the sell-off. Remember, when everyone switches, that's when you want to start looking for the technical reasons. We do know that we find ourselves in this week here. Now, traditionally, it's actually been sideways. So far, I guess it's been sideways to down, and we've hit 440. So will we see a bit of reprieve and markets come back up and kind of finish flat like they've done before in pre-election years? Here, this is 10 pre-election years taken, and you'll notice that the bottoming of those markets tends to happen around the last week of August. So it's actually kind of occurring exactly as it has in the past. Here are some interesting signs of things that have just happened. Number one, we saw a 3x leveraged Russell 2000 small cap position or trade. Now, we don't know whether this is, of course, pushing towards further lows, but it's out of nowhere and we have a dark pool transaction, which is quite large. And this is basically marking the possibility of some profit taking from a bear perspective after maybe entering this position here. You enter here, you take profit here. It's a nice little trade. So it could be that we've just seen a potential exit from a leveraged position on the way down, especially to the Russell 2000. We also know that junk bonds just posted a pretty interesting dark pool transaction over here. This could still be towards the sell side. We don't know yet. We know in the past that they've sold this peak off, which has acted as resistance, and this is the middle of the range. So basically the most traded zone anyway. Hard to figure out what's going on there, but do remember to watch junk bonds in general. And then there comes oil. USO, the United States Oil Fund, does look like it's probably in distribution and looking to sell. And this is probably the end of that oil run. Now that we've broken on back down and considering the amount of trades that we've seen through here, plus we know there was a big accumulation trade that went on over there, it makes sense that oil will give up some of its gains. It was a big rotation, but it's probably what we call a dead cat bounce in that case. The Qs also posted a fairly large trade. It was about 54 times, I think, the average, or 53 times the average. That's not really that notable, but it did happen near the close. And of course, we still are in earnings season. We did see some okay earnings. Target kind of beat the market's horrible expectations. We've got Cisco as well. And then, of course, Walmart is the next big one to come out, along with John Deere later on this week. Do remember as well, I believe NVIDIA is next week, so stick around for that as it will be volatile, and we'll post some updates on our expected options moves over on our X account or Twitter account. So make sure to follow in the links in the description down below, because we'll have a whole bunch of options moves along with the market forward PE updates, as we always do when we enter and exit the earnings season as a whole. So as of next week and the week after, we want to be looking at that. Let's take a look at something that changed in the options market. This is huge, and it's, of course, the first time we've seen it in 2 months. It's been a long time. So first up, relative big volume changes. There was a big volume trade across the board here in VIXpiration, which is where the VIX options expire, and we had some monster reads. Take a look at Amgen, 22.43 times the average 90-day volume. That's a significant amount. We also saw some big trades continuing to come out of J&J. What's going on there? That stock is certainly coiling for a pretty significant breakout. There's options all over that thing at the moment. And of course, we also have a whole bunch of pretty unusually large options trades through the majors. We also continue to see Moderna place massive trades, but for the first time, it's gone bullish. This thing's been in basically a sell-off now for months and months and months and months and months. Is that about to change? We'll be updating as we start to see a potential V shift as markets come down. Also, let's take a look at what was the biggest issue with, or the biggest thing that actually changed yesterday, which was 41 million. But look at this, finally, 52% puts versus 48% calls. This is the first time we've seen puts overtake calls for like 2 months. And it's a fairly significant thing. I think it's showing you that we're starting to come into what could be at least a temporary base for markets. In terms of unusual single options activity, there wasn't too many, but I did notice that there was an IWM put that was put in for October, which has a 64-day expiry. You'll notice here most of these positions are not expiring far off, but there are a couple of October puts that are quite large coming out, and these ones, 418 strike put here for the SPY, fairly large coming out for October. So again, people are still betting on volatility remaining relatively big. over the next couple of months in this very weird pre-election year style scenario. What about individual stocks? J&J continues to have some interesting transactions on it. Tesla, of course, always trades big. And then we keep going through. We've got a 120-day expiry on SU. And that's really the main ones that were coming out over the last 24 hours, along with a couple of big puts that are just ridiculous strikes. So obviously some Tesla traders doing a few things there. But let's talk about rotation. What's going on? Utilities was the best sector along with KIE. Now, does this really matter? Not really. It just shows us that the defensive sectors, being healthcare, staples, and utilities, made up the top. And of course, that meant that anything to do with technology, anything to do with growth was getting beaten around. Solar and clean energy always take the brunt of these sells, and they got brutalized. Also, gold can't handle this yield increase, so it's really struggling, which is a little bit of a shame because it, of course, broke all the lows, including Barrick over the last 24 hours. Let's have a look at the last 5 days. The best sector to be in was healthcare, and it was only 0.27% down in comparison to things like regional banks, gold, semiconductors, all these types of things that lost a hell of a lot more over that period of time. All right, let's now jump into what matters here, and this is going to be a big one for charts. First up, we've got a good indication of whether markets have finished their sell. Generally speaking, we want to see percentage of stocks above that 50-day moving average move back under 30. And we also want to see the percentage of stocks move underneath the 20, which is now hit, I would say, our target of 25. So it could be a bit of temporary relief as the S&P 500 comes into 4,400, which is a pretty key critical, of course, zone. And we're looking now for the technical reasons, which we'll talk about later on today's video, of where bounces could occur here and how they could occur. Because, of course, just because you think something's going to happen, that's a prediction. You'd rather react to the market saying, yeah, I've built a position, I'm going in that direction. US 10-year yields at the start of today's video we discussed. US 2 also coming under pressure. 5.1%, set your alerts. But I think the 10-year was certainly the big one here. And also 20-year and 30-year. They were all moving quite a lot higher. And look at this. This is a significant weekly breakout should it occur. It could mean that 10 years is going to continue to go up, and it's showing some interesting signs, and I think it's going to knock the market around if this continues. We also need to look at the volatility of the volatility. The VVIX spiked massively over the last 24 hours, showing us that we could be going for a little bit of underlying volatility spiking, similar to what we happened in March. Remember, at the moment, it's being suppressed thanks to these 0 DTE options and VIX suppression and all sorts of things. But the volatility of the volatility, it was spiking over the last 24 hours. And it shows you that the bears are still in control for now of this market, and they're still bringing some of the fear. But if we get something like 123 read here, that could also mark the bottom, something to be thinking about for now. JP10Y, what's going on? It's breaking out maybe. We'll see. Set alerts. If this goes out, it puts pressure on yields. It really hurts treasuries. And of course, treasuries are the one that's coming under the most amount of selling at this stage. So let's have a look at treasuries together. And it is not looking good. I mean, treasuries are 93.84. I've talked about this level for a while. I'm still liking this level, even as an investment kind of perspective long term. But at this stage, I think treasuries are going to continue to fall. And I've been angling at this 88 to 90 zone. I think we all have together. And we've been thinking, is this possible? This is a multi-year low. It's a huge deal if it happens, and it's going to shed so many people's positions that are underneath here. Unfortunately, the markets do sometimes go to these critical zones, and this is just a big area that we've been looking at for some time. We also know demand destruction seems to be in play. I mean, this higher yields for longer, yield curve barely dropping type of thing, it's putting pressure on copper. This is often seen as Dr. Copper. So basically, it tells us whether the world economy is hot or not, and it continues to look not very hot. China data doesn't look very good, and of course, the US is trying to do this to try to slow the market. Although core retail sales were so strong, you'd think that there's nothing wrong with the economy. It's kind of like good news is bad news at the moment, which is the weirdness that we're in. But yeah, copper, if it closes like this on the weekly, it signals further selling, possibly 357. That's not exactly the best thing for stocks either. And now let's move over to consumer discretionary versus staples. Actually less selling than you'd think here, showing that staples were actually dropping with consumer discretionary at the same time. They're basically holding each other as they go back down. 2%, 2%. They're kind of sitting with each other. That's weird. Usually a sell-off would basically have staples increasing or holding itself, and consumer discretionary would weaken. And I think a lot of this has to do with how strong that core retail sales was, and in general, how strong the US economy has been overall. And it's just holding that consumer discretionary better than you'd think. Also, Amazon seems to be holding up okay across the board, and that's a huge part of that market. Let's move over here to S&P 500 versus central bank liquidity. We're starting to come a bit more in line. You'll notice that central bank liquidity for the US, which is this green line here, that's been increasing a little bit. And this is what they do. They bring in a little bit of the guns without telling us. And then all of a sudden, what do we see? We see a little bit of support for the markets. US oil, we've had this one break underneath the trend line. It does look like it's going for that yellow line that we have here, which sits about 78.28. But I think USO is probably most interesting here. So if we pull up USO, which we'll just bring it on the charts, you'll notice that it's gone down below its daily 20 moving average, which I can tell you, not that I have it here on the chart, but it's about there. And we've closed below that point. We've also seen large trades through here. It's likely that the oil funds are going down. I think next up could be stopped for $68. And it does seem to be like that temporary run is over. And although we thought that US oil might be breaking out in the weekly, the problem with it is we're now below the long leg doji, and this just was so close to call. Now, if that had been a weekly close that was bullish, I would have gone with 92.90 all day. A lot of you were polled this week. We polled on our Monday stream, which we do every week if you're interested. And what we found was that no one had any idea. Basically, we were all like a quarter at where oil would go next. It turns out that it looks like it's going weak. And if it gets underneath 78.34 a barrel, then we're probably moving even further down. US dollar, this is super strong. This thing just doesn't want to stop. And it puts in another rejection off the wick here. There's no sign of turn at this stage on US dollar. It continues to strengthen. It's now hit pretty much my main targets. So, next targets would be somewhere around up in here, which would be about 103.50. And then the target after that would be 104.10 or so. So US dollar is very, very strong. And that's putting pressure because of this yield increase on 10-year as well. And that's putting pressure on gold, which continues to slide. It's been sliding. I did hope that someone would find buyers around here for gold originally, but of course, once that got taken out, what can you do? Barrick also fell underneath, and of course, GDX has also fallen underneath. So it looks like it's going to be a slide for gold thanks to yields for a bit. There is a huge issue in here, which is basically an unfilled kind of massive gap that basically sits there in very low volume. So if we end up closing the weekly underneath this level, I could see gold actually move lower into the 1840s and even 1850s. And then all of a sudden we might find some significant buys here. I like this zone quite a lot, but unfortunately with gold, it tends not to come really very good again until November. So it could be quite a while till gold actually finds its legs again. And that could be also coinciding with things like stimulus from China and other yield style situations from central banks. This is the one that a lot of people have been looking at, a bad close for Tesla. And frankly, it doesn't look like it wants to stop. That's a close on the low after rejection. And it just basically is trying to put in, you would think, that 200 to 210, which we've been talking about. It's possible we even go to 180. So for Tesla buyers, is it time to buy the dip? This is not really the candle that you generally say is an excellent candle for buying the dip. I would say it's probably going lower. But what do you think in the comments down below? Let us know. Apple, another new low as well, closes very similar to Tesla, and it closed underneath. Now, if you're an Apple fan, you want to buy this stock, we have a bit more structure here. If we make it back above about 180, 150, which I think is what is here, but 181 flat, then that would be significant. And I think that would probably mark the temporary dip. But at this stage, that's not a great candle. It kind of points towards further weakness coming. And we know that the back of August is the weakest period. So that's where, if we're going to put a low in, statistically, we generally do. So could we be seeing a flash sell throughout next week? It's possible. This is not exactly the candle you want to see. I will be watching Apple very closely. We all will together, and we'll be checking it out. Let's move over to Nvidia. Nvidia continues to reject this area. I don't really like selling Nvidia at this time of year. I do like the idea of semiconductors being weaker, which they are, but Nvidia in general, the problem with that one is it has got earnings and it does tend to hold into earnings. In fact, usually it's something that I would go with the bullish side into earnings, but this year is a little bit different, as we know, with the statistics, with what we've seen. So it hit the 61.8 and sold off for 2 days so far. That is a weak period for it, a weak area. And, earnings is going to be probably what holds it up or brings it down. So I think this one is just waiting for that. Semiconductors across the board, though, were weak and they continued to sell. Now, even the little strong potential turns didn't really turn yet. We found here Disney just made it underneath my box. This is where I suspected buyers would recommence for Disney. We saw a sell day, but now we get a little doji. We're looking for a break above that, and that's going to be hopefully the beginning of a little V. So it's not like a super solid trade. It's like what I'd call a 6 out of 10, but this is the type of position that I'd be looking for. And what I'd be looking for here is the beginning of a V. So remember, buying the dip is one thing, but that's a prediction. When you buy the V or you buy the turn, you actually improve your odds a little bit. So just keep that in mind. Hopefully that's a bit of a tip that helps some of you out there. RK, I want to bring up hypergrowth stocks. They are getting absolutely smashed, but they're coming down to interesting zones. RK's most traded level is here with a big range that could be bought through this zone. So could this be actually where the markets are going towards for a bottoming effect? Well, there's so many hypergrowth stocks that are making new lows. Just to give you a couple of ideas or a couple of concepts, if you take a look at PayPal, it came underneath the previous low and pressured it. And you can see here the weekly, look at that, it's pressuring that extreme low. We saw SE doing the same thing with the bad earnings. It pressured the low and then tried to pick back up. Huge volume trade there. Possibly there's some reprieve off those points. So many of these hypergrowth stocks are actually making right on the lows. And this is where stop loss gets hit, liquidity gets stolen, and all sorts of shenanigans happen. So we're watching those quite closely as this event unfolds. Utilities also took lows. So utility is an interesting one. If it gaps up, it's got a little island reversal down here on the low point. And of course, 65 would mark, I think, a significant change for utilities to go to the bull side. So something we're watching, something we're looking at on the charts as well. CQQQ keeps coming under fire. A lot of selling in China right now. I still maintain that I still think September back end will be very interesting into October. I do expect October to be the time when they announce stimulus. We'll find out. I mean, basically, it's still the same technical analysis, the same concept, though it is getting brutalized at this point. So remember, it's not a trade. It's more of an idea of accumulation. We've seen some of the bigger investors coming into the Chinese market around these levels. So obviously they're starting to sniff it out. They're expecting, they will wait for the catalyst though before, of course, they pull bigger triggers. Let's move over to German 40. This market and the indices here is continuing to weaken. It's in line with our idea of Wyckoff. Of course, if we do end up taking this 15,400, we could be in for a more significant sell across all indices around the world. So certainly one that we're watching closely. The Australian market, the Australian ASX 200 continues to fall. I don't see too much reprieve or buying pressure here, especially when we think energy might be topping now based on the new analysis. And that could push us back down into 7,000 for the ASX 200. It started with a double top, it rejected, and now it's down here. So luckily we had a neutral to bearish idea on it. US 2000 hits a relatively interesting trade level. It hit a bigger one hit a big one the other day. The biggest of all is 1750. I mean, 1750 is a huge zone. That would line up very well with like a 4150 and 4200 on the SPY. And that would be what I would call like a really nice correction if it occurred. Here, no change of trend yet, just smashed straight into it. It is a zone where you could see some buying through this previous structure, but nothing at this stage. US 2000 hard to read. What about the NASDAQ? The NASDAQ's also on a demand zone. Big weekly level, big daily level. No turn at this stage on the smaller time frames. As we scroll through, we go to 15 minutes. We just got nothing. There's very little structure here. If you were looking for the next 24 hours, you'd probably wait and say, okay, well, I want to see it do this. I wouldn't mind if it did this as well and then did that. If that happened, it would kind of point towards, okay, we can get a little bit of a reprieve rally. But at this stage, the trend is down. It's in demand, sure, but the trend is still down. S&P 500 smashes into our watch zone area, this is where we expect structure to start building. So we'd like to see the S&P 500 find some buyers, again, create structure so that we can make better informed decisions rather than being predictive and saying, oh yeah, 4,400, it's going to buy. We don't know that yet, and we don't have any information that says that anybody wants to buy it. It closed on its low. That's not exactly significant to, oh, it's going to buy instantly. Usually when it closes on its low, it means that rallies get picked up and pulled back first, or it keeps selling through, and then it might rally after it creates structure. So we're looking for that. Let's go to the US 500 in the futures to see whether we've got any yet. And the answer is unfortunately no. I wish we did, but we just don't have any structure yet. I will update you all over the next 24 hours if we do start to see structure. At this point, though, it's just hit into a key level. I think some people will have taken profit here. I don't blame them. And it's the first of the most likely zones we got to. Are we back to mean reversion? Are we back to any of those things? Some people are going to be asking. The answer is not yet. We still have a little bit of a way to go. And that's actually as a percentage for the S&P. We're talking about another 2% down would get us back to mean reversion, which for anyone that doesn't know is the 20 moving average on the weekly. And it's a pretty big level and certainly a very important area. And I'd say that would mark up around 43.30, 43.50, that kind of zone there. Maximum pain now, are we hitting it? The answer is yes. We are literally sitting right on maximum pain on the SPY. We also know that there's a bunch of puts and calls that have all opened everywhere, so that's made it a little bit more confusing here on this chart. But we've got 3 million almost units. We've got trillions of dollars of options expiration. We do not expect the market to be below 430. And of course, at the start of the week, we didn't expect it to be above 450. So 440 is a good little level. It makes it like we hit target. Now we look for structure. We look for the next move. If it does fall through 440 clearly, then it could go to 430 and then come back up before, I would say, expiration. At least that's a guess. What about crypto? Well, altcoins are getting smashed, but take a look at Bitcoin. It's putting in a bit of a sell here. And this is pointing towards that 27.5, 28,000. So it is pointing towards weakness and further selling here coming in the crypto world. So be a little bit careful there over the next 24 hours. It could be explosive should it actually take some of these lows. And I expect it to kind of, melt a few levels if that happens. It's been coiling for a while. The trend's been kind of down on the small time frames and up on the big ones. But Bitcoin could be coming back to the most traded levels. So it's looking weak here on the chart. Any other bits of information? Well, we've seen the FOMC meeting minutes. Now we get unemployment claims on Thursday. But really, the big news is over. Now the markets are really trading around options. Do we remember with OPEX, generally the Thursday is more volatile than the Friday itself. So that's something to keep in mind because, of course, that's what we're entering into. If you enjoyed today's content, remember to subscribe, smash that like button. Thank you so much for watching. We appreciate it very much. And to each and every one of you out there, I hope you're doing okay in the markets right now. It's tough out there, but of course, this is the expectation of what happens in August. And we usually get a double dipping event in September. Bye for now.